Hi, it's Aoife Devitt. I'm recording this on Sunday, October 5th, and I wanted to bring you some highlights of the live podcast event that we did in San Francisco on Friday, October 3rd. The camera quality was a little iffy at that particular recording, so rather than try to edit that, I thought I'd send you the snapshots of the audio where we collected insights around whether there is a bubble in AI and how this is being expressed anecdotally. We asked about the consumer's experience of inflation and equally that cognitive disconnect between the markets being as strong as they are and the state of confusion that we're seeing in the backdrop. So I'm going to share the slides that I used at that presentation on Friday, and I will at times stop speaking here and let you hear the audio from the room. I hope you enjoy it. At our live event, we discussed the usual shutdown shenanigans. We looked back at the third quarter. We talked about bubbles as well as baubles, suggesting that we were talking about whether there was or was not an AI bubble, but also spoke about these trophy acquisitions and asked whether they were baubles. And then, of course, we did try to get a view from the ground. So, having discussed the shutdown shenanigans, there was another meme that had come across the books just on Friday that was regarding the Grim Reaper and some of the cuts that were being made as a result of the shutdown. We spoke about the fact that there had been no sign really of equity market weakness in previous shutdowns, and that was discussed in our previous podcast, and equally looked at some of the slides showing the race in terms of equities, race to the top, it seems, with 29 highs being reached in the S&P, 9 on the Dow. And equally, we discussed movement in the bond market and how bond prices were proving to be quite resilient. They were all generally expecting a further rate cut from the Fed. And a lot of this was based on the very poor employment data that continues to trickle out. We can see that the loss of 32,000 jobs in September had been a challenging one for the US, and equally that this was the backdrop still was of the Fed independence, and we suggested that the Fed independent discussion may be losing some of its sting as we got closer. And the words we used previously were twilight of the administration, and that was something that was quite interesting. So in the room, we had a collection of representatives, all consumers living within San Francisco. Many came from the venture capital ecosystem. Many were invested in tech stocks. Some worked with the private wealth domain and some with institutions. So it was very interesting to get a cross section of opinion as to how they saw the current disconnect between equity market strength and some of the economic malaise. Let's hear what they had to say.
I think that the market is ahead of itself. And the PE ratio historically has never been consistently this high. So I think it's a concern because I don't know if growth can continue at this rate. So I have my doubts personally. And I also think that there's a certain memification going on in the markets, with certain companies and strategies. And I think that that could burn off. That sugar high could burn off too. So I'm concerned. But so far it just keeps going up.
Exactly. It is confounding. I just pulled up that valuation chart there showing that the S&P 500 valuation price earnings are at their highest level since 2021. And then when we see these gray bars being the Fed chair warning, and sometimes it comes exactly on time, and sometimes it can be a little early down here. But clearly, when he didn't say the word irrational exuberance this time, but I think it was a very similar emotion. And that is, he's been maybe the institutional memory, Jerome Powell, who has sustained throughout time and will last, it looks like, till his time is up.
In May.
At this point, it's so short, the time to run
it.
Exactly. Probably will last. Exactly. Any other thoughts on this disconnect?
I don't know that you want to get into the AI aspect of the valuation question yet, but that's certainly something that everyone is talking about. That of the 8 big tech stocks, are they 30% of the S&P or the Dow Jones? And part of what's being valued into them is this high. Their investment in AI is receiving a high multiple, and is that justified or not when it's sort of a technology that's still in its R&D phase, essentially? So it's part of what I worry about.
Yeah, well, I think given we're sitting here looking at the Salesforce green area and we're sitting here in San Francisco, we probably should. Let's touch on that in a minute, but I'd love to see if anyone else has any thoughts initially on the disconnect.
I think part of it is also can be lent to some of the AI beginnings of the integration, because the one difference, and not the deadly phrase of it's different this time. However, a lot of these companies are more profitable than ever before. And I think that is receiving a premium, that you have the most profitable companies in history that continue to lean into that. Not to say that it fully, rationalizes such exuberance. But I think that on top of rate cuts that are coming because of jobs is just leading people to say, all right, this is the beginning of a bull run, and it's just going to keep going. And I think there is some fervor coming from that. So I don't think it's completely unjustified. There are attributes that can say, all right, it's reasonable that there is this growth here, but there are questions of how long can that be sustained. I think it is quite real.
The market overall seems really high, but I have a very good friend who's been saying that for 10 years and he missed out on a lot of great returns. So I tend not to react too quickly to this. I have been rebalancing lately. Nvidia, 8% of the stock market by some measures was too high for me. So I sold some of that and rebalanced. Also, I've been looking at other asset classes like venture capital, crypto, and I'm still mostly in equities, but I'm looking at other doors.
Then we turned to the question of an AI bubble, and let's hear what our guests had to say. First, we started looking at the anecdotal evidence of a bubble, and then we heard what they were hearing on the street, and we heard what they were thinking when it comes to the overspend, as they deemed it, in AI and where this was likely to end.
I've invested in a particular AI startup that I went in maybe about 2 years ago when it was, seed investment, and they've already done 2 or 3 rounds of additional fundraising at increasing valuations just over that short span of time. So it's interesting. I didn't go into the follow-ups because I felt good about my initial basis. But it's interesting to see all of the companies kind of just experiencing that with the frenzy for investors wanting to get in. Mm-hmm. And then, of course, are they producing something that is a viable product yet? Not yet, because they're still doing the R&D around it. So.
Yeah, and it's interesting. One of the slides I have here is a Bitcoin treasury. When you mentioned people wanting to get in, sometimes it's just, do the investors fully understand what they're investing in, versus just they see a name, they see AI, this case they call Bitcoin treasury, and they just kind of get on the bandwagon, a bit like blockchain used to be. And it wasn't a meaningful pivot at all. It was just a kind of an opportunistic, let's say we use AI, and all of a sudden our valuation is pumping up. And any other insights in terms of this bubble discussion anecdote?
I think also the credit markets are giving us some signals of potential, overinvestment perhaps in this area. When you look at some of the credit facilities that are being, negotiated, the spreads are so tight right now, and that's always a warning sign, that they're able to borrow at very, very, favorable rates with favorable terms. So I think that's also something to think about too, is how are the credit markets reacting to, just the overall stock market, and in particular the tech financing.
Right, because the credit markets would usually be the most bearish, most conservative, most risk aware of the segment of the market, and if they're not seeing it, given the tightness.
I think you definitely hear, even from CEOs and executives of the largest tech firms, saying we'd rather overinvest than underinvest, and that can both be that's exciting but also scary, because as an investor you don't want wasted capital. But it is very much an arms race, and you think about any arms race, the one that doesn't invest, gets falls behind. And it's really, would we rather overinvest and come out the other end with a little less cash but be the winner, or not? And I think those emotions definitely lead into it, and from that perspective as well, not just from the management of these tech companies, but from allocators and investors, of trying to pick the right horses, or many horses, and don't want to be left behind from that.
It's a great point. I think these numbers, such as their cash flow, such as their cash pile, then in a way they can take the risk. They'd rather not become the type 1, type 2 error worth to be left behind. And given that probably this arms race will only have 1 or 2 winners, and there's a need to get on that bandwagon. Any sense from you all, the bubble question, that who will be the winners?
So go ahead.
No, go ahead.
I do think the clearest winners will be kind of actually the derivatives of the tech bubble. It's energy, for sure, whether it's clean energy, oil and gas. The sector has been so underinvested in for really decades now. And the one thing that every group here needs is energy to fuel the data centers. But you also have, beyond that, the world is getting wealthier. You have a rising middle class around the world. We've cut poverty globally to just a tiny fraction. And with it, they all want the luxuries of middle class, which is all fueled by energy. I think even alone, Silver Lake last year or 2 years ago estimated that AI alone would use more energy than all of Argentina, which was like top 10 user of energy. And so from that perspective, that's a clear winner. Even if there is overinvestment from chips, from data centers, that it's kind of a value play, in that there's this growth and catalyst into assets that are, in many cases, extraordinarily cheap. And I think that's just a clear winner, no matter who the end, if it's OpenAI that takes market share or whomever, we need energy regardless.
And that's a great hedge or diversifier if you think about it, because even if you're concerned about being in the top 10 tech names because they're over stretch valuation today and definitely behaving in a more volatile way, having that kind of a pick the shovel of exposure broad-based and even globally, where we have a lot of government investment in data centers, say globally, obviously the no resistance to clean energy, green energy in Europe. Certainly demand for all of it everywhere. That might well be a good way to diversify that. Nikolai, you're already coding with AI, you're versed in it. Besides the comments on the bubble, do you have any thoughts on that since the MIT report, some of the other reports that suggested we were overstating productivity gains and that maybe we were jumping to conclusions based on the use case there?
Well, clearly AI is in the very beginning of its effect here. There's a lot of work that goes in discovery, trying to find out what works with AI. I think unlike blockchain, which is just a technique, I see AI more like the advent of personal computers and how it changed the work of like how we work literally over the last 30 years. I think AI will have a similar, very broad effect. It will take time. It's not unusual in the beginning that we're just looking for stuff, right? And even AI itself often acts like an eager puppy. Like you ask it a question, I want to please. And similarly, I think companies are saying, we have to get into this and do something. But clearly there's some pockets where there's huge effect. For example, with coding, if you know what you want to do and I'm not saying that anyone can create great applications, but certainly someone who knows what they want to do and has some technical background, there's a 3 to 10x productivity gains. It's incredible. I think it will affect other parts. You complain about no one answering their phones when you try to see if your coffee shop's open, for example. Well, in a few years, an AI will answer the phone every time and all the time and give like pretty good answer 95% plus of the time, and then maybe route to a human. I think that's all going to happen. And I would not speculate on how broad that will be, but I think it will be very, very broad. So yes, a lot of potential there. On the overinvestment, I think it's going too fast, like so many data centers. But there is a factor of contrary to like overproduction in China that makes the prices collapse. The tendency of technology, especially with information, is that the capacity will be used for something, whether that is useful or not. It's not like having extra capacity will sit idle. It will not sit idle. It will do stuff, but will it be useful stuff? I don't know. So I'm worried about the energy impact. I'm convinced that the investment's too fast. We know why. It's arms race, right? We know why, but it will get soaked up.
Yeah. But the interesting thing, that idea of slack infrastructure, if it's a depreciating infrastructure too, even more reason to use it quickly. I think that's the issue, because otherwise it's expiring.
I think that, you alluded to that in your initial comment, that I think the chips themselves are, 60% of the total cost of building the data center infrastructure. So is it a melting block of ice, or is it something that can sit and wait until the slack tightens and now you're ready to use it? Or will there be more efficient LLM models that can use the older chip and still be efficient? And will there be sort of discrete and concrete use cases that have a revenue generating potential? These are all questions.
They're great points. And I think there's some of this bubble analysis has been Exponential View. This blog from Substack has brought out this kind of bubble dashboard, which suggests that we're not really in the red zone yet. You mentioned the funding, the debt levels. We're not at high levels of debt. We're not at strain. They've plenty of cash they have to spend there. And the industry, maybe the industry itself is at a strain point, but it's not in the red. Revenue growth probably is it's certainly very good. We're seeing that there. And the funding quality, it seems to be very high, but it's not being tentatively raised on debt at this stage. This at least is one suggestion that the dashboard is we're in the green. And the further point that is made here is just around this overinvestment, this capex, the spend, just how much that has increased dramatically. That is it certainly has been fueling the boom, but again, is that sustainable? And if growth projections are being based off that kind of massive investment, which has been made probably on the back of some fairly stretched valuations, is that sustainable? And I thought there was some interesting. This is a kind of classic definition of a bubble. And I'm just going back to Steve Jobs quote, because you can really only join the dots backwards. So you can't usually see a bubble emerging until it's already burst. And then you look back and join the dots and see, well, that was the reason. That was what we didn't see. I'd be curious to know whether we've ever learned from our mistakes, and that we certainly have failed to foresee some of the other causes. I mean, one or two exceptions, the doomsayers of the last crashes, but whether there's just this exuberance that we don't see it today. There's some of the points is debt being taken on during the build-up. That was the point you made, Bill. It has been taken on. It's probably not at unsustainable levels yet, but it's been taken on. And we know that it's somewhat cheap money, I guess, currently. And I think the most interesting point is this convincing narrative to explain away the high price and the valuation. So we have plenty of narratives that are being inserted in today in terms of why it's justified. We just cannot get our head around these big numbers, perhaps, but we need to spend $1 trillion on compute. It's not somebody put through that number out there a few months ago, and now I think it's totally normalized and fine. So I think that we're adjusting quite quickly to these kind of numbers.
Lastly, I thought I should ask my guests who live in one of the most expensive cities in North America what they are experiencing in terms of inflation, what they are seeing around them in terms of consumer strain, and whether there is a disconnect between this on-the-ground experience and some of the headline numbers that we're seeing. I've shown a tariff chart here, as we did speak about the effect of tariffs and generally did a vibe check on the economy. Let's hear what they had to say to close this out.
As a sub 30 person in San Francisco, it's very hard.
Yeah.
And I think that's kind of the dichotomy that we're talking about here. Huge numbers of enterprise investment, private investment into the country. But from a consumer's perspective, it's really tough. You mentioned kind of subprime auto loans. Well, interest rates are still really hard for most people. I think it's actually been thought of mine recently of why you're seeing so many more young people getting into equity markets, potentially why there's so much retail push into equities. We can't buy houses. Yeah. We can't buy homes. So the only alternative is really to grow our nest eggs as young people is in markets. And I think there's been an adoption of that of trying to build our own wealth because every other place there's pressure, whether it's here buying a car, getting a space for that car is often cases more expensive than the car itself. So I feel like the consumer is very much being, for lack of a better word, strangled in many ways. At the same time, we're talking about trillions of dollars being invested in AI build out and enterprise. That's the kind of the tale of two economies here.
Excellent point. I would completely agree. Anyone want to violently agree with that or disagree?
I do notice completely anecdotally, for example, in the suburb that I live in, I live in the East Bay, just outside of the city, and I'm a different generation. I'm an X, and I have kids who are graduating high school now, and one just went off to college, one's a senior, and so my husband and I are starting to think for ourselves, what's next? And so I've started keeping a little casual eye on home sales in my area. Do we want to move on to the next thing? I do see listings that are lowering their prices, and things must be slowing. I haven't officially been watching the data as a real estate economist, but anecdotally, it seems like things are sitting a little bit more. The aspirational price isn't being reached, and the agents are lowering them. So maybe you'll get a house.
And I do think these rates are just simply the mortgage rates. Yeah. I mean, now that their refinancing periods have cycled around, and I think the percentage on 2% mortgages is shrinking. These rates, this is why I suppose there is this drive to get rates down because they're simply too high.
I think anecdotally also that it's very tough for younger people. I mean, my kids are out of college, 29 and 27, but they feel very pessimistic for their group in particular. I think maybe they'll be fine, but for their group, they feel very pessimistic, as Ethan was talking about. The ability to do the same things that we in my generation, which is older than Rebecca's, the baby boomer. It's going to be more difficult for them, and they see the challenge. The challenge ahead. And, I think, both of my kids are in New York City and they're seeing similar, barriers to definitely having a car, let alone pay the rent and everything else.
So based on that, it seems like the Fed lowering rates would be good news all around at the same point. And it's almost like, yes, it could have a stimulating effect on inflation, but we know that transmission is lagged always. Monetary policy seems to have less of a direct effect today, whether it's because the rising rates didn't affect us because we had locked in mortgages, or maybe the dropping rates will not necessarily flow through to inflation because of this AI offset that we mentioned, the deflationary effect that AI ultimately has.
I think also Fed rate really helps companies and individuals with financial assets. And I think some of the populism that occurs in the United States and outside the United States and Europe in particular, that's all because, this Fed stimulus or central bank stimulus and fiscal stimulus mainly impacts folks with financial assets. I think younger people are feeling disenchanted with their ability to take advantage of things like that, let alone working class folks.
Interesting.
And that was our discussion. Clearly, as we can see that at every generation, there is a sense of things being challenging when it comes to the job market, as well as prices starting to pinch right across from every level. So it's clear that there is a disconnect between that number that we're seeing in the headline and what the consumer is experiencing on the ground. There was a relative buoyancy in the room. Most of these individuals, also particularly the younger end of the spectrum, because they cannot afford to buy homes, were invested in the stock market. So we're taking advantage of the uplift that these record highs in the stock market are providing. But I think it's also important to note just how uncertain they feel about the future, even when it comes to AI. I think there is a sense, just like the companies, that would rather not be caught short in terms of spending, that each of these individuals would rather not bet against AI and can certainly see the beginnings of its transformative effect. But there was a little bit of a nagging concern that the investment in AI did seem to be overstretched, even now at the outset, given all of the uncertainty built in. It was so fantastic to get together in a room with a live audience after a little bit of a break. We will be taking this up again and coming soon to a city near you. So look forward to seeing you there. Thank you everyone for listening to our snippets from our live podcast in San Francisco.